Investing in, buying, and selling real estate in California. A complete 2026 guide for property investors and homeowners. California remains dynamic and challenging real estate markets in the United States. With its booming tech economy, diverse geography, strong population growth in certain regions, and persistent housing shortages, the Golden State offers significant opportunities for investors, buyers, and sellers. However, high median home prices, projected to reach a record $905,000 statewide in 2026, according to the California Association of Realtors, CityCar, combined with regulatory hurdles, high taxes, and varying local market conditions demand a thorough, strategic approach. This comprehensive guide provides everything you need to know about investing in, buying, and selling property in California in 2026. Whether you're a first-time investor creating video content for audiences interested in U.S. real estate, a seasoned flipper, or a homeowner looking to upgrade or cash out, this detailed resource covers market trends, step-by-step processes, financing options, legal considerations, risks, and proven strategies for success. California Real Estate Market Outlook for 2026. The 2026 California housing market is characterized by stabilization rather than explosive growth or decline. CAR forecasts a modest 2% increase in existing single-family home sales and approximately 3.6% appreciation in median home prices. Mortgage rates are expected to ease towards 6.0% on average for 30-year fixed loans, improving affordability slightly compared to recent peaks. Inventory is rising modestly, projected near 10% growth in some areas, giving buyers more options and slight negotiating power. However, supply remains constrained due to strict zoning, high construction costs, and environmental regulations. Demand stays strong in job-rich areas driven by technology, entertainment, biotechnology, logistics, and agriculture. Key regional variations define the market. Coastal and urban centers, Los Angeles, San Francisco Bay Area, San Diego. High prices, lower yields, but strong long-term appreciation. Median prices often exceed $1 million. These areas suit luxury, value-add, or short-term rental strategies. Inland Empire and Central Valley, Riverside, Sacramento, Fresno, Bakersfield. More affordable entry points with solid rental demand and job growth in warehousing, manufacturing, and government sectors. These offer better cash flow for investors. Secondary markets. Areas like Sacramento suburbs, Loomis, Folsom, and parts of the Central Valley provide balanced growth. Challenges include tenant-friendly laws, equals rent control in some cities, eviction restrictions, high property taxes under Proposition 13, base 1% of assessed value with reassessment on sale, and new construction hurdles. Opportunities arise from accessory dwelling units, ADUs, which many cities encourage to increase housing supply, and 1031 exchanges for tax-deferred investing. For video creators targeting California property audiences, highlight visuals of diverse properties, from beachfront homes to Central Valley single-family rentals, and data-driven narratives on ROI in different submarkets. Top cities and areas for real estate investment in 2026. Successful investing requires location-specific analysis. Here are standout markets. 1. Sacramento and suburbs. Stable capital city with government jobs, affordable prices relative to the coast, and strong rental demand. Good for long-term buy and hold. 2. Fresno and Central Valley. High cash flow potential due to lower purchase prices and consistent tenant demand from agricultural and logistics workers. 3. Riverside Inland Empire. Proximity to Los Angeles jobs without coastal prices. Strong population inflow and industrial growth. 4. Bakersfield. Underrated for yields, with energy sector ties and affordability. 5. San Diego and Orange County. Premium markets with biotech and military-driven economies. Better for appreciation and vacation rentals. Emerging opportunities exist in smaller towns with lower competition but growing infrastructure. Always analyze job growth, population trends, school ratings, crime statistics, and future development plans using tools like local MLS data, Zillow, or specialized investor platforms. For investors, focus on properties with ADU potential, as these can boost rental income significantly. Multifamily units or small apartment buildings in transitioning neighborhoods also perform well. How to invest in California real estate. Strategies for 2026. Real estate investing in California spans several proven strategies. Buy and hold rentals. Purchase single-family homes or multi-units for long-term rental income. Target areas with 1 to 2% monthly rents relative to purchase price where possible. Factor in vacancy rates, typically low in growing areas, and management costs, 8 to 10% of rent. House flipping. Buy distressed properties, renovate, and sell. High construction and permitting costs make this riskier in California. Focus on value-add opportunities in inland areas where advanced strategies for California real estate investing, buying and selling in 2026. Expanded guide for video content creators and investors. Building on core market knowledge, this expanded section dives deeper into nuanced tactics, emerging trends, detailed case studies, financing innovations, legal updates, risk mitigation, portfolio scaling, and content ideas tailored for California-focused property videos. In 2026, California's market offers a balanced environment with statewide median home prices projected at a record $905,000, a 3.6% increase, and sales volume up 2% to approximately 274,400 units. Mortgage rates are easing towards 6.0%, inventory is rising nearly 10%, and affordability is modestly improving to around 18%. These conditions create opportunities for strategic investors who move beyond basics into sophisticated approaches. Deeper market analysis and regional opportunities. While primary markets like Los Angeles, San Francisco, and San Diego command premium prices with strong appreciation potential, often 3 to 4% annually in coastal zones, investors seeking higher cash flow should target secondary and inland areas. Sacramento stands out for governmental stability, steady job growth, and balanced rental demand. Properties here often deliver solid cash-on-cash returns, with median prices more accessible than coastal counterparts. Fresno and the broader Central Valley provide exceptional cash flow opportunities. Lower entry prices combined with demand from agricultural, logistics, and manufacturing sectors support consistent tenancy. Rent growth in the Inland Empire is projected around 3.2% annually, driven by affordability migration from Los Angeles and Orange County, plus industrial expansion. Riverside benefits from proximity to major job centers without the extreme pricing. Emerging micro-markets include Bakersfield, energy sector ties, areas around Folsom and Loomis near Sacramento, and select spots in the Antelope Valley. For luxury or appreciation plays, focus on San Diego's biotech corridor or Orange County's resilient Class A assets. Video creators can produce compelling market tour episodes comparing coastal versus inland ROI, complete with drone footage, rental comps, and interviews with local property managers. Data-driven investors use tools like investor calculators to model scenarios, base, bear, and bull cases factoring rent growth, vacancy, typically 4 to 7% in strong areas, maintenance, 1 to 2% of property value annually, and property tax implications under Proposition 13. Advanced investment strategies for 2026. Beyond standard buy and hold or flipping, consider these refined approaches. ADU explosion strategy. California continues encouraging accessory dwelling units to address housing shortages. Adding a permitted ADU can increase property value by $200,000 to $400,000 plus, depending on location, and boost rental income significantly. Target single-family homes with backyard space in cities with streamlined approval processes. Videos demonstrating how I added an ADU for $150K and increased cash flow 60% perform exceptionally well. Value-add multifamily conversions. Purchase older duplexes or small apartment buildings in transitioning neighborhoods, renovate, and reposition for higher rents. Focus on areas with strong job growth but dated housing stock. Short-term rental hybrid models. In tourist-heavy zones like Palm Springs, San Diego beaches, or near national parks, combine long-term stability with seasonal Airbnb income. Navigate local ordinances carefully. Some cities cap rental days or require permits. Track regulations via city portals for accurate video advice. 1231 Exchange portfolios. For active investors, rolling gains into higher value or better cash flow properties remains powerful. In 2026, identify like-kind opportunities in growing inland markets while exiting high-tax coastal holdings. Syndication and fractional ownership. Partner with groups for larger commercial or multi-unit deals. Platforms facilitating crowdfunding allow smaller investors exposure to premium California assets without full management burden. BRRRR on steroids. After initial rehab and rental, refinance aggressively, aiming for 75 to 80% LTV where cash flow supports it, to pull out capital for the next deal. In stabilizing markets, timing refinances with rate dips maximizes efficiency. Calculate key metrics rigorously. Aim for cap rates of 5 to 7% in growth areas, higher in Central Valley. Cash-on-cash returns of 8 to 15%, and factor in California's high insurance costs, especially wildfire zones requiring robust coverage or state-backed favor. Comprehensive step-by-step buying process with 26 nuances. 1. Financial foundation building. Beyond basic pre-approval, stress test scenarios with rates at 5.5 to 6.5% and potential property tax resets. New buyers face full market value reassessment under Proposition 13, so budget for the jump from sellers' low base year taxing. Save 20 to 30% down, plus 3 to 6% closing costs. Explore DSCR loans. Qualify based on property income, not personal DTI. Ideal for portfolios exceeding 4 to 5 properties. 2. Agent and team selection. Engage a buyer's agent experienced in investor deals, plus a real estate attorney, inspector, and contractor network. For videos, film agent interview questions that audiences can use. 3. Property hunting tactics. Use MLS, off-market lists, driving for dollars, and direct mail to motivated sellers. In 2026's slightly higher inventory, negotiate seller credits for repairs or rate buydowns more effectively. 4. Offer strategy. In balanced markets, include inspection contingencies, but waive or shorten where competition exists.